Today's lecture is called The Art and Science of Trading. One thing that you have to do on the practical side for this module is to actually trade on a simulator. How many of you have not yet set up an account on Oanda, a practice account? Okay, so that's something we need to have done by the end of today. This is meant to be a primer. Mainly an introduction. So some of you who have already been trading, you might find this a little bit basic, but it may be a useful refresher. Those of you who have not been trading, or if this is their first time, you'll find this quite useful. Subsequent lessons will build on this foundation and will go deeper into the various analytical methods and techniques that we use to analyze market movements and formulate trading strategies. Okay? I am recording this lecture, which will become available on Blackboard, so please do cooperate with me in terms of the sound, which means we'll have to put a do not disturb outside the door in case somebody disturbs us. Okay. Now, let me begin by telling you, or by sort of discussing, what exactly do we mean by trading. Trading is speculation. We are actually buying and selling assets. These could be stocks, shares, bonds, currencies. These could be derivatives, which are not actual assets we own, but we are simply taking positions in the movement of prices. There are two actions we can do. It's a binary process. We can either buy or we can sell. Okay, that's all we can do, and that's all traders do. Now, a trade is essentially a bet that is placed on a price change. The price can go up or it can go down. Now, last week we talked about how do you make money if the price goes down. If the price is going up, you're trying to buy low and sell high. You're buying the asset, or you're taking the position at a lower price and selling it when it goes higher price. And that's what we call a long position. Now, those of you who were not here last week may find the second bit a bit complicated, but those of you who were here last week will remember that even if the price is going down, we can still make money. And we do so by taking a short position. We short high and we cover low, right? Now, I keep in mind that I used to just notice that I use the term cover, not sell, not buy back. Yeah, but the reason why we say cover low is because if you are shorting high, you're actually shorting borrowed assets. So you've got to cover that when the price goes down. So that's it. I mean, those are the two primary strategies, primary actions, the two main actions you can take when you're trading. A trading decision essentially is therefore a decision on what asset to trade, how much to risk on that trade. The more of that asset you buy, or the more you invest in that position, the more you're risking. When to enter that trade, if you're going long, for example, when to buy, and when to exit the trade, and that's when to sell. Now, the when question is not necessarily one of time. It can be one of market conditions. You can say, I will buy when the price reaches that point, and I will sell when the price reaches that point. So you're defining the time the moment you buy and the moment you sell, not in terms of the time or the date, but in terms of the price level. Okay? Or you can define it in terms of the market conditions. When that happens in the market, I will buy. When that happens in the market, I will sell. So essential to keep in mind that when you say when, is not necessarily defined by time. It consists of those signals or conditions that need to exist in order for you to take that decision. Okay? It sounds very simple, doesn't it? If it is that simple, then everybody would be making a lot of money. Now, the total return that you will make as a trader is made up of multiple returns, the cumulative total of multiple returns. So let's say you placed a trade, your trade one, you place trade one and you made a return of R1. You made a trade two, you made a return of R2. You made a third trade, you made a return of R3. Now R1 may have been positive, which means you made a positive return. R2 may be negative, in which case you made a negative return. R3 may be positive again, and so on and so forth. So the total returns that you have at the end of a period is the cumulative total of all the returns that you have made over that period. And that's what this formula tends to signify. Okay, it's like a war, and the outcome of the war is determined by a series of battles. Some battles you win, some battles you lose, but the overall outcome is on net how many battles you do win. Okay. This is a model of decision making that I like to adhere to, and it's something that I've actually applied in practice, especially as part of my doctoral research. It's very simple, and it's very understandable. So let's stick with that. And it's something that's very applicable to your situation where you're students and you're trading in a simulator, okay, and the kind of instruments that you're trading. Up here, excuse me. Up here is your trading decision, and that consists of the what to buy, the what to trade, the when to trade, when to enter, when to exit. That's your trading decision. So all those components of the trading decisions are up there. A large part of your trading decision is dictated by your judgment. There are two kinds of trading. There's what we call the systems trading, and there's the discretionary trading. What I'm going to talk to you about for the rest of the module is that one there, the discretionary. I'm not a great believer in the systems trading. Systems trading, I think, is flawed. If you are going 100% into systems trading, it means somebody builds a computer model that gives you signals on when to buy, when to sell. And you don't need to have any expertise. You don't need to exercise any judgment. All you got to do is blindly follow the system. Now, if you're an industry insider, you would know that many inexperienced traders come into the market thinking, oh, this system is going to work fantastically well. I will spend a lot of money buying that system from some computer geek, then applying that system to my trading, and then I will make lots of money. A lot of people have lost a lot of money doing that. Okay, trading, I believe, is about judgment, and that is your judgment. I'll answer questions at the end. Yeah, trading is to a large part about judgment, and this module is based on the discretionary decision-making aspects of trading. Now, having said that, having a systematic trading approach, a systematic plan, what I call a trading plan, is essential for that to inform that judgment. So your judgment as to what to trade, when to trade, etc., can be determined by an analysis of the price data. For example, if the price data is moving upwards, if the price is moving upwards, is it going to continue keeping moving upwards? Are you going to enter the market long? Or do you think it's going to take a downturn? And are you going to go short? And when you're trading, we say when you're trading, you're always trading on the right-hand side of the screen, meaning what's going to happen next. So you're not dealing with the history, you're dealing with the future, and that's where you come. Well, that's where you got to deal with probability of what's going to happen next. So one aspect of your judgment will be based on the technical analysis, and we're going to go into technical analysis in a bit more detail in this lecture. Technical analysis mainly of price and even volume data. And this can be processed through what is called a trading plan. Now, we're not going to be covering trading plans in detail in this lecture, but later on we will be looking in more detail as trading plans. A trading plan is essentially, in this context, a checklist of rules saying, if this happens, do this. And this is something that you create as a trader and is individual and personalized to you. And it gives you a set of basic rules of thumb that enables you to inform your decision-making process. But it does not exempt you from making a judgment. Each trading decision is a judgment call. There is also the analysis of macroeconomic fundamentals. We know the macroeconomy and even the political economy affects the markets or the market prices. And you need to understand the market that you're trading in from a fundamental point of view. Is the market overvalued? Are there major macroeconomic trends or risks that affect that market so that you should keep out of that market? At one point, especially in soon after the 2008 crisis, you had a situation where the stock markets were in decline, and you had the commodity markets like gold that were consistently going up, and that was a flight from risk. And then there were moments in things like the FTSE 100, the S&P 500, where all of a sudden there was sort of a rebound, and people thought that these were, long-term recoveries. They weren't. They were just sporadic upturn movements that went down again. So you need to discern this by your understanding of how the macroeconomy works. And certainly leading up to the 2008 bubble, there were many economists, one of them being Nouriel Roubini, who actually predicted that the financial sector, the derivatives industry, the CDOs that were based on the housing market were fundamentally overvalued and would have to crash at some point. So understanding of the macroeconomy and the macroeconomic fundamentals is essential. And you'll notice that in your module study guide, there are 2 sessions devoted to understanding the macroeconomy. In addition to that, you have other factors that affect your judgment, and you need to be conscious of that fact. That is, you're not a mechanical being. Traders are human beings, and they're not mechanical. You process information in a very human way, and other factors do affect your judgment. One factor, more notably, is your personality. Your personality can affect your judgment. You can also have herding behavior. You can have friends who are making money in one market, and you decide, oh, I'm going to go into that market as well. Right. So a number of other factors can also affect your judgment, and that's something you need to be conscious of. I'm just going to take a pause because I see a few people have questions. All right. Okay. Here I have in front a sorry. Okay. Say she has to go. Okay. What you have in front of you is the S&P 500. That's the Standard & Poor's 500. from the period January to September 2013. That is from the beginning of this month to about now. Okay. And what you see generally is an upward trend. Okay. And this is something you can actually observe just simply by looking at the price movement of the S&P 500 over that 9-month period. And that's what price is. The price, or the market price, to be more precise, this is the market price, reflects the market consensus. Do you know what consensus means? Consensus is agreement. It's the market consensus. What everybody in the market agrees is the value of that asset at that given point in time, right? So what you do observe is that the market consensus on the value of an asset keeps changing from time to time. Now this is the daily chart, so what you see are daily movements. But if you were to narrow it down to a single day, you will see minute by minute movements. And that's something you got to keep in mind, that the market consensus is rather fluid. I use the word rather because it gives a degree of uncertainty. And the more liquid a market is, the more fluid it is. Now, what does that mean, liquid? It's easy to sell and easy to buy because there are many buyers and sellers. There are many buyers and sellers. For example, the market for if you own a house or if you own a flat. Let's take it more simple. Let's say you own a mobile phone. The market for mobile phones over on eBay, for example, might be more liquid than the market for used trainers. If you try to sell your trainers on eBay, do you think there's a second-hand market for trainers? Maybe for some unique brands, but not the common trainers. But there tends to be a healthier second-hand market for electronic devices like mobile phones. So the liquidity of the market is determined by, if you have something to sell, can you sell it easily? Will there be many buyers willing to buy it? And if you got many buyers, they'll be bidding for it. One will be coming up with one price, another will be coming up with another price, and the agreed price is the price where the buyers and sellers agree on. Right? So the downside of liquidity, the plus side of liquidity is that if a company wants to, say, issue shares, if an S&P 500 company wants to issue shares or issue new shares, they will find a ready market willing to buy it. But the downside to it is the price of its shares will be subjected to very high level of fluctuations. And that level of fluctuation is what we call volatility. Okay. Now, this is what we call a basic line chart. And having the one-year line chart for the S&P 500 index actually gives us a much broader perspective on the trend of the market. So you can see that this year the S&P 500 index has been on the up in general. And you will see that it is, even though it is going up, it doesn't go up in a smooth line. There are ebbs and flows. So this is an ebb, and then it starts flowing again. Okay, and that's something you got to keep in mind, that you may have a general trend, but there are ebbs and flows within that general trend. Now, this is the same S&P 500 that I showed you earlier, but in the form of what we call candlesticks. Some call it Japanese candlesticks, some call it Chinese candlesticks. Essentially, it's these vertical sticks that have a sort of a wick like a candle sticking out, Some are green, some are red. You see that? Okay. Now let's have a look at what that means. Now this is a candlestick up front, up close. Each candlestick will have 4 basic points. The highest point is the highest price that was reached in that time frame. So for example, if you're looking at daily candlesticks, that's the highest price that was reached in that on that day for that asset. The lowest point on that VIX, on that line, this is what we call the VIX. Okay, so let me just make a note of that. My spelling may not be accurate. That's the lowest price that was reached on that day. Now here we have the body of the candle. This is the body of the candle, or what we call the real body. Okay. The lowest point, if the candle is green, what that means is, as a result of trading, the price has gone up, meaning the price at which the market closed at is higher than the price at which it closes. Sorry, let me rephrase that. The price at which the market closed is greater than the price at which it opened. So when the market opens at 8:30 in the morning, it opens at one price. And the market closes at 4:30 in the afternoon, it closes at another price. If the price at 4:30 in the afternoon is higher than the one in the morning, when it opened at, it would have a green body. So the close price is greater than the open price. Whereas if it opened at a higher price and it closed at a lower price, that's represented by a red body. So it's gone down. So here the market has gone up. Here the market has gone down in the course of that day. This is the highest price that was reached, and this was the lowest price that was reached in that day. Okay, so this is called the upper shadow because it's the high end, and this is called the lower shadow. Right, that's what a candlestick is. Now, I like candlesticks, or I used to like candlesticks, because one of my earliest system of trading was based on candlesticks, because I was a day trader to begin with, and as a student, that's manageable because you're not committed to a long-term desk. You're just trading for that on that day. Now, this is the same S&P 500 index, which I have focused for the month of April to July. So this is for the month of April to July. So it's a narrower focus of that S&P 500. Now, what I observe here, and what I can possibly use as a system, is that if you have 3 green candlesticks, that is a signal for the start of a bull run. A bull run is where the market is going up, right? And that gives me a signal to enter the market and go long on the market. Okay. The end of a bull run is marked by a pattern that looks like this. You have 3 reds, and you can see there was a major. This is at the top of the peak, top of the mount. On this day, there was a major battle between the bulls and the bears. You got to keep in mind the bulls are trying to push the market up, and the bears are trying to push the market down. Okay. On this day, there was a major battle. It opened at this point, it closed at this point. That's obvious. But look at the length of the high and the low. Look at the length of the VIX. There was a major fluctuation in the market. And that signals indecision. That signals a major battle for consensus. And the fact that it ended red, it ended low, shows that this could be the signal for the end of the bull run. and 3 further red ticks indicate that there is consensus that the market should be lower than when it started. Right? So this could be taken as a signal for the end of the bull run. So if you're a sensible investor, you'll get out right about now. You'll not risk it, because it is possible that the bull run will not continue, that it might turn down. Okay. And then again, here you see it's undecided. It's sort of trending. There's no trend. It's sort of a sideways movement. And then here again, it picks up the 3 consecutive green stick candles. So I used to be looking out for these 3 ticks, 3 green sticks, right? That signals the end or the start of a bull run. But it's always preceded, or it has to come after a period of indecision or a bear market. Okay. Keep in mind that I'll be using the term bull and bear a lot, and you'll hear that a lot. A bull market, a bear market. A bull market tends to drive the market up. The bear market tends to drive the market down. Okay. Or you can say the market is bullish or the market is bearish. You can use there are systems where they use the length of the candlestick as well. Yeah, there's a whole science of analyzing candlesticks if you're into it. I'm not saying you have to be, but if you're a candlestick geek, there's a whole science of analyzing candlesticks. And that's all it is, and that's the beauty of mathematics. You record the high price, the low price, the open price, the close price, and you translate it into something that gives you signals about market behavior. Now, if you're using price charts as part of your trading analysis, technical analysis, and you will be using price charts. What am I saying? You are using price charts as part of your technical analysis. You need to keep in mind one golden rule, and that is the trend is your friend. The trend is your friend. And virtually every author who writes on trading or trading strategies will agree with that. You're trying to look for trends that you can pick up on. Professional traders learn to identify patterns, and they use these patterns for their advantage. Which brings you to the question of what do amateur traders do? Amateur traders are not so concerned with patterns. They're just concerned with making money, right? So they will think they've seen a pattern, but they haven't. The difference between professional traders and amateur traders is professional traders have studied patterns over a long period of time. So if you want to improve as a trader, most of what you're doing on the technical analysis front is analyzing and studying patterns so that you have an objective understanding of how patterns in a particular market develop. Technical analysis is the use of charting technology to analyze patterns in market price. Technical analysis has many techniques. 3 that I'm going to cover in this lecture are some of the basic techniques. One is called the trend line. The other is the support resistance line, also known as the SR line. And the third is the moving average. Okay. Now I'm going to flip over to Oanda to give you a demonstration of how you can use these in your trading window. So this is your Oanda window. And actually, I'm going to take you to the S&P 500. So the S&P 500 on Oanda is denoted as USSPX. I'm going to increase the size of the chart so you can see it more clearly. Now, I've superimposed some studies here which I'm going to get rid of. Now, you can change the price chart by changing the using the functions that are available there. So, for example, here I have yeah. Let me just okay. So, okay. Here we go. Right now, I got a candlestick up on the screen. You can actually change it to a line chart. So that's your basic line chart, and that shows the average between the high and the low. Or you can change it to something called the Helkin-Ashke, which is similar to a candlestick, or the open, high, low, close bar, right? So you can take your pick as to which chart style you want to work with. There's no rule that says one chart is better than the other. That depends on your preference, okay? I'm going to actually stick to the candlestick because that's my preference. I've chosen to go for a 1 day option here. So each stick shows a 1 day, and I'm looking at it from March to September. I can actually zoom in by using that button there. That actually enables me to zoom in. So this is just for September, August, and I got a much close-up view. Or I can zoom out and get a much more expansive view. So here you can see I'm going back to January 2011. Right, so this is a three-year look. So you can zoom in and zoom out any which way you want. And once you're in that, you can actually scroll left, scroll right. And the decision you make is always made at this end of the screen. What's going to happen next? Okay. Now, here, this is a sort of a 3-year perspective, and you can actually look at, you can actually draw a trend line. So the trend line, to get a trend line, you look up that icon, and there that gives you a number of options. You draw yourself a trend line here, and a trend line has a starting point, which you'll click to activate, and then you can draw it any which way you want. Basic tip is if you're drawing an upward trend line, try to locate it at the bottom ends of the movement. If you're drawing a downward trend line, try to locate it on the top ends of the movement. Okay. Now that's a trend line. To delete the trend line, you can click on that and you can say remove the trend line. It'll get rid of that. You can draw a support resistance line. Now what I'm about to show you is a support resistance line, and to do that I'm going to narrow down a bit. Okay, and look for a good position to draw the support resistance line. And I might actually go down to a 1 hour window. Okay. Now, drawing support resistance lines works like this. Over a given period, and usually it's a shorter period, you will find that the markets can side trend. They actually fluctuate, but they actually fluctuate between 2 points, an upper point and a lower point, right? The upper point is what we call the resistance line, and it simply is a vertical line drawn at the point that where you see the market has reached and it's sort of come back down. Now you may ask, why not go extend it all the way there? We call this portion acceleration, meaning it's gone up above that support resistance line, but it's sort of realized it and come back down. Right? And here you can, at the lower end, you have what is called the resistance line. And then here you also have deceleration. Right? Now the thing with a support or resistance line is that how do you know that that is reliable? Well, it has to be tested. Testing a support or resistance line involves looking at how many times it has touched that line and turned back around. So here it's touched it once, turned back around. Here it's touched it again, turned back around, right? And the more often it does that, we call it tested. You're testing a support or resistance line. Now, the danger of support or resistance line is they're relatively short term. After a while, those support or resistance lines can be broken. The market will find a trend and break through that support line or break through that resistance line. So that's something you need to watch out for. So that's basically how you introduce a support resistance trend line onto your platform, onto your screen. And when you do read the technical press, especially the sort of newswire and the technical analysis that's coming out on the news function and the technical analysis function there, you will see experts telling you, this is what they think is the support level for this market, or this is what they think the resistance level is for that market. So that's something you will need to pick up on. But then again, you will need to use your own judgment whether you think that's right for you based on your trading strategy. Okay. Now, one more thing I want to introduce you to is something called this moving average. Now, the moving average, what you see in front of you is a rather, up and down, quite rugged movement of the price. You can smooth this out by using what we call a simple moving average. A simple moving average can be found not up here but down here where it says study. So these are the various studies you can actually introduce into your chart, and we'll be going through these studies at some point in more detail. The simple moving average is abbreviated as the SMA. Okay. And you can insert your SMA. It'll ask you for how many days you want the simple moving average to be inserted for. So let's say you pick 14 days. It will insert a line there that shows the average price for the last 14 days. That's what it means, is the average price for the last 14 days. There is a technique in which you superimpose two moving averages, one short term and one long term. So if I impose another moving average, but this time make it 55 days, right? And you can see that where it crosses over, it indicates it signals a turn in the market. Where one moving average crosses over another, it signals a turn in the market. Now, this is a very rough illustration, but on your independent study folder for this week, I have a set tutorial on how to use moving averages. Okay, so as a rough illustration, what I can sort of show you is if you look at this point, when it crosses over, it signals a change in the market direction. Right? So if you get the right moving averages to cross over, you have a signal that gives you which way the market is about to turn, or whether the market is about to turn. Okay? This is, like I said, this is a very crude example, but in your Blackboard, you have a tutorial on the use of moving averages. So those are the three technical indicators that we're going to cover for this lecture. We're going to go deeper into technical indicators at some point in your future lectures. And now returning back to your lecture agenda, price charts are, the fundamental market data. The fundamental market data. Sorry, not the fundamental, but the primary market data is going to come from your price charts. But you got to keep in mind that price is a reflection of the market consensus about what the asset is worth at that moment in time. And the market consensus, or what the market thinks, is the value of the asset at a moment in time, and especially at future moments in time, is determined by a whole range of other factors, not least the macro environment. The macro environment is everything that goes on around the market. Things like changes in oil price, things like political crisis, economic policy changes. These will all have an impact on the market depending on which market you're trading in. To illustrate this point, I've just picked up I'm sticking to the S&P 500, and I'm looking at the August to September price chart. This was the time, and this market trend, you can see, was a very clear downward trend, and this was largely driven by the crisis in Syria. Remember, there was a moment where the U.S. was trying to get consensus, build up an alliance to go for military intervention in Syria. That made the markets really nervous, and it went in for a very long dip. And Reuters actually reported it as the worst month since May. And it was largely driven by the uncertainty over possible strikes in Syria. So that's a macro environment issue that's affecting your market price. Now, when Congress sort of retreated on approving military action in Syria, and the market saw that military action in Syria, may not happen, and also combined with the fact that car sales in the U.S. actually went up, this drove the S&P 500 up again. And that's something you got to keep in mind, that markets are driven by economic fundamentals. And when I say economic fundamentals, I don't just mean GDP, GNP, unemployment, inflation. I mean the whole host of issues that impact on the economy. That includes political, social, even astronomical. If you're looking at a possible meteor hitting the city of London, touch wood. Huh? Weather, yes, weather. I mean, the weather can affect. I mean, if you're trading commodities, which you are not, things like coffee. J.P. Morgan has a whole team of meteorologists and geologists whose job it is to forecast the weather, and most of them are employed in the commodities desk, because things like coffee, the price of coffee can be affected by weather. If the weather in Ecuador is not right for growing that coffee, and the quality of coffee is going to be poor, then you're going to have a dip in the supply, and the price is going to jump up. Yeah, exactly. Okay. So a lot of things can affect the market. There was a time when I think it was President Clinton choked on a pretzel while watching Monday Night Football, and the markets went down on the news that President Clinton had choked on a pretzel. Right? That's how sensitive markets are. Certainly, things like monetary policy announcements. Every time the governor of a central bank, the Bank of England, or the Federal Reserve Chairman like Ben Bernanke speaks about possible monetary policy action or expected inflation, unemployment rates, these can affect the markets. Things like consumer confidence. Has consumer confidence gone up? What about, especially with the U.S. car sales indices, employment levels, changes in these kind of indicators will also have a profound impact on the market. One tip for you about how markets behave is expectations. Markets are driven largely by expectations. If something happens, and the market did not expect this, it was unexpected or relatively unexpected, you will see a reaction. You most likely will see a reaction. But if the market had been expecting this, and it happens, then you may not see a reaction. And you wonder, hold on, why is there no reaction? And the reason for that is the market has already discounted this. Now, the word I use up there, discounted, it simply means that the market has factored this into the price because it was expecting this. Now, when you do this for real, what you're going to find is that, especially in this day and age of information technology, the volume of market information that you have is huge. It's astronomical. It's quite literally infinite. If you want information about virtually anything, you got it. And if you were to go through all the volumes of all the types of information and all the layers of information, all the volume of information that's out there about the market, the economy, etc., you are not going to be able to get to grips with it in your lifetime. That's how big it is. So a large part of a trader's job is this: information management. You need to be strategic with the information that you use. Clearly, you cannot be using all the information that's available because the volume of information available to you is humongous, and no one trader can expect to know everything about the market. And that holds true for analytical techniques as well. I mean, we saw 3 very basic analytical techniques, but if you go through Oanda, and if you were to even go through the Bloomberg side, the number of analytical techniques available to you, tops the 1,000 level. There are thousands of analytical techniques that you can use. And traders are coming up with new analytical techniques that are being added onto these networks. So they're virtually limitless, and no one trader can be an expert in all these analytical techniques. The good news, and you have to be aware of the fact that you as traders, you have processing limits. There's only a certain amount of information you can digest, and there's only a certain number of analytical techniques that you can master. The good news is you don't need to know all this. In fact, the percentage of all the information, all the techniques that you really need to know, really need to get to grips with, is only a very small percentage. It's not a question of how much or how many. It's a question of how well. How well you know it, how well you use it, how well you've mastered it. So the advice to you is learn to use a few techniques well, rather than trying to learn as many techniques. And this is something that amateur traders do. They start with one technique and say, oh, this is not sophisticated enough. Let me move on to a more sophisticated one so that they'll give me better signals. That does not necessarily work. The techniques you use, the techniques that you use, and the information you use and how you use them must suit your individual preference and needs. The techniques you use and the trading systems you build, the trading plans you devise, these are very personalized. In fact, if I were to adapt somebody else's trading plan, chances are I may not be able to use it either at all, or I may not be able to at least use it as well as this person has been using it, because it suits that individual, suits that individual's needs, personality, traits, skills, analytical prowess, etc. And the flip side of it is you have to be creative in coming up with your techniques. You have to design, test, and implement your own trading plans. Okay, and that's the subject of your second assignment. Your second assignment asks you to design, test your own trading plan, your own trading strategy. Okay, and for this you can use any number of information sources or studies or technical analysis tools that are available, but you have to put them together in a way that suits you. Okay. Now, price charts are not the only information that you should use. You should also be conscious of the fact that Markets are surrounded by a macro environment, developments in which will affect the market sentiment, will affect the market consensus. And therefore, keeping abreast of the corporate, financial, political, economic news is essential. Particularly of interest to markets are things like inflation reports, unemployment data, consumer producer confidence indices, economic events like Federal Reserve Chairman or Bank of England Chairman testifying about monetary policy, that is setting of interest rates. All these, A, you need to understand them, and my lessons on on the macroeconomy will help you. But B, you need to be constantly keeping abreast of these. Now, like I said, trading decisions are decisions you make on the right hand and right end of the screen. So if I were to turn back to your O&A chart, if you were to place a trade, if you were to take a position on S&P 500, the question for you is it going to go up, or is it going to continue downwards, or is it going to go lateral? Which way is it going to move? So it's always at the right end of the screen that you're working as a trader. And there is no certainty. There is no certainty that it's going to go down, it's going to go up, which direction is going to move, what happens next. There is no certainty. There is only probability. And that's why the science of trading is built around probability theory. Okay. Now, the reason for that is markets are driven, like I said, by expectations. Physicists and other natural scientists have brought the tools that are used in physical sciences and applied them to studying the markets. We're going to see a video on that at some point later on to do with the long-term capital management issue. And to a large part, I think the financial crisis that we just saw was due to just that many of these systems or strategies that banks used, and many of their portfolio building strategies particularly, were based on what were seen as perfect scientific models. But there is no perfect scientific model that can model the randomness of human behavior. Okay? And it's not just one or two humans we're talking about, it's a vast number of human beings. And their opinions, their expectations conflict with each other. So markets, especially in the short term, are very fluid. Virtually anything can affect them, and it's that sensitivity that you got to keep in mind. One of the major weaknesses of traders is the overconfidence. In part, overconfidence results from you having gained a certain return recently and thinking that this return was because of your skill. It may not. It may be random luck. So the more you move from being sort of a novice trader to a trained trader, what you're doing is you're trying to take the randomness out of your decision making. But you need to have a very healthy respect for the fact that no one can know everything about the market. Anyone who says, I know exactly which way the market is going to go, is either lying or is a fool. Okay? Now, my job on this course is to build some discipline into your trading practice. And that's one of the fundamental starting points in your training. And the reason why discipline is important is that as human beings, using discretionary methods of trading, you are bound to be affected by that all familiar human trait, emotion. Right? Now, it may not affect you so much when you're trading what we call paper money, which is not real money, but certainly when you're trading real money, the emotional level is just going to go up, right? The common mistakes that traders tend to make, they can panic. They enter a trade too early, and the panic can cause them to enter a trade too early or too late. I've been there, I've done that, right? You may be monitoring a certain market, and you may be thinking, oh, it's just it's gonna go up any minute now. Let's go into it. But then you realize too early. It went down. It actually went down, and then you panic. You think, oh, I'm wrong. It keeps on going down, so that you get out of it, and then you realize, an hour later, it's turned back up and it's going the way you wanted to go. So if you panic, it'll cause you to enter trades too early or too late. The disposition effect is a closely studied psychological effect, and it's where traders hold on to loss-making positions for too long, hoping that it will return to profit. And this is one of the things that we observe in the psychological behavior of traders, that if something is making a profit, if something's making a loss, you don't want to get rid of it. You don't want to cut it off. You want to hold on to it, thinking, oh, it's going to turn back around. It's going to turn back around. It's going to turn back around. It may wind up making you even bigger losses. And this is where discipline is important. You have to have a trading plan that gives you a rule that says, if the proportion of capital that is lost at any point is this, I'm going to stop it. So the trading plan is part of your discipline. It gives you a definite stop loss level. The opposite of this is greed. The prices are going up, and you're holding on to it thinking, oh, it's going to go even further. It's going to go even further, and it's going to make a bigger profit. So the prices are doing that, right? It's going up, and you're holding on to it, thinking that it's going to go up again. But what you find is that, the markets do turn back around, and all those profits you did make are wiped out because you held on to it for too long. And what's causing you to hold on to it for too long is the greed. Okay? Now, a trading plan can actually help you reduce the impact of these what we call cognitive biases, and this is how behavioral finance started out. Now, we did an experiment earlier on, didn't we, in the first class, where we looked at making decisions between two risky positions, and we demonstrated on collective mass, we are cognitively biased when it comes to choosing between options. Okay, and a trading plan is designed to bring a bit more objectivity, so that when you're making your judgments, you're not driven entirely by human emotions and the weaknesses, and you reduce the level of cognitive bias on your trading performance. I'm going to take a pause here because I realize that there are some questions, and I think I'm not going to give you a break, but I'm going to sort of take some questions. Okay. Now, just to illustrate a bit more or discuss a bit more about your trading plan. A trading plan, and this is something we'll go into detail at some later point, a trading plan should address some very key issues. First of all, a trading plan should give you an indication as to what asset to trade. So when you do construct a trading plan is a set of rules, a checklist that says, this is the asset you trade, this is the this is the moment when you enter the trade, this is the moment when you should close the trade, this is how much you should risk, and it also informs on what basis, on what analytical indicators you will execute that trade, and what market information to use. So it'll actually narrow down the range of analytical tools you'll be using, and also narrow down the range of market information sources that you'll be using to do your research. Because any trading plan, any trading system, or any trading strategy is built on a great deal of market research and analysis. The strategy you use, the trading strategy or the trading plan, and I use the term trading strategy to mean trading plan. Okay, sometimes I use the two interchangeably. The trading strategy or the trading plan you devise will determine what sort of market information you will access and what sort of analytical tools you will use, how frequently you will trade, how frequently you will analyze, etc. Now, the basic objective of trading plan or trading strategy is to take the guesswork out of it. Without it, you're just gambling. It's just a guess. It's an art and a science. The technical tools you use are scientific. The way you test a trading strategy is scientific. But to begin with, it's an art. You're creating it. You're creating it out of your experience, out of experimentation. So what you're right now, the mode you're in right now is experimental mode. You're experimenting with various strategies. You're figuring out how the market moves. You're studying various patterns. You're identifying the markets you're going into, and that and the more rigorously you do that, the better you will be able to come up with a trading strategy that has a reasonable level of success. Okay. It signifies your creativity, and is also something that's personalized. It's personal to you. Like I said, one person's trading strategy may not be workable for another. Now the science comes in when you're testing it. So once you come up with a trading strategy, you need to test it. Does it really work? Or did it work just because you limited your data set to a certain range, and within that data range it works, but on a different data range it doesn't work? And this is where you need to test your trading strategy, and that needs to be done scientifically, because you need an objective opinion as to, can I rely on my strategy? If it doesn't work, what you do is you go back to the drawing board and you rework it. Okay? So a trading strategy or trading plan is a process of continual improvement. Okay, I'm going to give you a 5-minute break before I go on to the next bit.